Hi guys, Loz here. Alright, there was a post on Facebook that I made. I can't remember exactly how it was structured, but I think I mentioned something to somebody and they were coming back literally saying that how they were a little bit disgruntled as well, but they have a different way of expressing their frustrations. I, on the other hand, am very vocal. I don't really care what people think about me. At the end of the day, it's my opinion. If people don't like what I have to say, they know where the unfriend button is, or they don't need to follow me. But that's not the purpose of this video. The purpose of the video is to basically help this guy out, and maybe help anyone else out. The guy misunderstood my post. He thought that I was being ripped off by this person. No, I was not ripped off by this person. My friend was. Okay? But without getting into that, um, this guy I felt a little bit sorry for because they're asking him for some more money. And he's already paid out a lot of money already. Now, I've got my own reserve opinions about that because I don't want to upset the guy anymore because he's going through a bit of a difficult spot right now. But after laying out $6,000, he's struggling now. He was put into a false sense of security that this was the best thing since sliced bread, and he thought it was going to turn his life around, and it thought it was. I mean, a lot of people thought that their life was going to be turned around, and for some people, it was. They were able to grasp it straight away. Um, and for me, when I tried this, well, when I watched the videos weren't the best. And I'm not saying that I'm the best video maker in the world when it comes to teaching people, but I think I have more clarity when it comes to explaining things, and I'm not condescending to people when I try to teach them like this person does, like this other person does. Um, so, if you're familiar with this setup, you might know who I'm talking about. I'm not going to mention no names. I've already, you know, made my rant. So I'm going to give you my take on how to use this setup. Alright? People have asked me, do I use it? Oh, no, I don't. Because I know how to read candle patterns. And I explained in one of my posts that the way that this setup is being made has been constructed in such a way where it's being rehashed. It's rehashed stuff on how to trade. Alright? But it's been systematically broken down. Alright, I'm giving the guy some props on how it's been broken down and how he's identified the patterns in the market and put sort of these indications in their certain places to show you certain areas of the market that you should look at. That's all fine. I'm not, I'm not, I'm not putting that method down. Okay. I mean, there are a lot of smart people out there that see the market differently. I am one of them. Unfortunately for newbies, they don't really grasp this. And for the way that it was taught in the videos that where people are asking for continuous support and where they're being asked for more money, I mean, you might notice where they're actually charging more now. They have like a workshop, like a boot camp workshop, where you have to pay a monthly fee. Well, guess what? That was my idea. Why was it my idea? Because I was a part of the marketing team, or was going to be a part of the marketing team for it. But after a few things that wouldn't get sorted out, I decided not to go ahead with it for certain reasons. But anyways, um, so even after some of those boot camp groups, a lot of people dropped out because they still weren't able to work out what was going on. I was gonna actually create a bunch of videos for that group on showing them my way on how to actually make it a little bit more simple, and just rather than bashing people like I've been hearing a lot of, I'm rather than shouting at people to tell them to get their fucking neck straight, which is how it was pronounced. You know, if you can't do this, you're too stupid. You better go back to your 9 to 5. That's how the wordings were made. You know, anyways, I'm still going on my soapbox here, but I just didn't like the way it was being presented to people, and it really kind of pissed me off. So, and you know, reading this post on Facebook, it kind of brought back those memories. So I wanted to show people my take on how to use this. Alright, now the elements that are being used here, some people might have actually seen me use these boxes before. This is where I actually got the indicator from. Alright, but I didn't incorporate his method because I incorporated a completely different strategy using these boxes. Now, one of the number one rules that you should take from this demonstration is that you should never trade inside the blue box. The blue box will always go on for a period of 8 hours. And the period of those 8 hours will be from the very beginning of the day, when your broker opens up. Generally, normally GMT, but he'd like to use, I think he used GMT hours, but I'm going to explain it my way, alright? And hopefully it will make a little bit more sense, give you a little bit more clarity on what to do. So, the first rule that you should always adhere to is to never trade inside the blue box. Alright. These areas here that are marked in kind of a lighter different colour, these are the areas and when the dealing desk are changing hands. They converse with each other after the first team have come on and they've done all their analysis and they work out how many people to catch long and how many people to catch short and this, that and the other. So like here for instance, we've got, let me just cough a second, sorry about that. So let me just give you an example. Over the 8 hours as the day began, alright, this is like where the spread is being made by the market makers. And it needs to be like within a 50 range box. Those are the ones that you want to sort of really focus on. Any ones that are outside the 50 range, you want to actually skip that day, unless a pattern emerges. Alright, but what's happening here is that it's taken it from the previous day's high, it's pushed it up to another high. Now we can see that this white line here, he likes to refer to it as a tracer. This is really depicting what the high and the low was of the previous day. So what he's essentially saying is that it forced the people into believing psychologically that a high of the previous day was broken, and it's trapping those retail traders in because a lot of them are using simple breakout methods. So they trap the longs, they pull away, create new lows for the day. The Asian session box, which is for 8 hours, creates the high and the low of the day. If the high or the low of the day does not get broken, that's normally said to be believed that that will be written in stone for the whole entire day and maybe for the whole entire week. They can also be referred to as anchor points, which is also referred to in the videos or in the slides that you may have watched. So what's happened is that they've trapped the longs, taken out the breakout traders. They've then switched the highs to a low to create the low for the day, and they've gone back into yesterday's range, into the US range. This brown box here, already brown box, is yesterday's or the day prior's US session. Okay, so they've come back and then they've put it back into the previous day's session. Alright, so the market makers have come in and they're starting to do their analysis. So they tried to reinstill the notion that the trade is going to continue going back up the other way, because there was quite a bit of a breakout here from this cluster because it's collecting orders, and then it pushed up higher. So it's creating that false sentiment again that it's going to go up higher, and it also broke the high again of the yesterday, to maybe again to reinstill that faith that it's going to go up higher. Alright. Okay, so after they finish their analysis or whatever, alright, the market starts to drop. They've let go some of their positions. It's dropped, goes back up again. This is probably retail trading sentiment right here. And what's happened now is that an M formation has now been created. Alright, never trade inside a blue box, always trade outside it. So an M formation is created, and there's your first leg and there's your second leg. You always trade on the second leg, never on the first leg. Alright. So once you get in here, now these moving averages, they're basically visual aids. Alright, you don't really need to use them. Once you understand how to use candle analysis, you'll see these patterns as clear as day. And don't make the mistake like I did. Didn't learn candlestick patterns until years and years and years into my career. I didn't even know what candle patterns were, let alone how to trade them. You know, but now it took a long time to learn them. Well, not a long time, but several weeks to learn how to use them before doing any more trading. It opened up a new world to me, and I was making far much more money. So right here, he uses these as visual aids, and he gives you these arrows as an extra visual aid. And you also get a pop-up box that pops up as well with a sound alert to let you know that the yellow and the red, which he refers to as mustard and ketchup, when they have crossed over. Alright, so that's the EMA 13, and that should be the EMA 5, I believe. Yeah, there you go. Okay. Alright, so the market starts to pull away from the high of the previous day, and it's trapping in all of those people that went long. And they might be putting their stop losses, I don't know, maybe below the range of the US session or something. And eventually they all get hit. Alright, so all the stop losses have gone. Had you been on the right side and been patient and not trade inside the box of the Asian session, you would have been in such a very good position, you know, not just mentally, but financially. Okay, look at the M4 level. I'm probably going to do another video about M4s and M3s and this, that, and the other. I mean, this video's already gone for 12 minutes, 13 minutes now, and I want to try and get some of the basics out of the way first before I move on to the next one. And if you like this video, I'll do another one. Alright, so we have the M formation being created. We get an alert to go short on the crossover. Now, that's not to say that every time that you see one of these, that you go long or short on them. No. That is blind, stupid trading. You never just do it based off one thing. You always have a backup accompanying you to back up that idea to go long or short. Always have a confirmation. Always, always, always. And we've got a lot of confirmations here. Alright. First of all, we've already seen that the high was broken. And again, we don't trade in there. So that's one piece of information. We wait. And then we start to see that the market's going back up. It broke the high again. That could be our second confirmation to go long. But no, it's not. Why? Because we have an M4 medium level of support and resistance there. Okay, we never buy into a resistance. Never, 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 never. Whether it's a medium or whether it's a strong support or resistance. Okay. Alright, so we're still looking for a confirmation to go short here, or even a confirmation to go long, and so far we haven't had any confirmations to go long based on this strategy that I'm trying to explain. Alright, the M formation gets created inside the European session. Perfect, that's what we want. That's a part of the pattern that's being explained. Look out for the perfect M formation, or look out for the perfect W formation. Here's a W there. So this could possibly go back up again. Don't know yet. We'll have to look back a little bit more in the past to see where we are. Alright, now there's still a lot more that I could be saying about this, like finding the highs of the weeks, of the previous week, like the high of the week and the low of the week, as well as the low of the day, and as well as the high of the day. Well, the high of the day is right here. Okay, that was established by the Asian session. The high of the day on this one is over here. Alright, for this blue box. Okay. Are you all with me so far? So we've got our first confirmation is never to go to trade inside the box, so we wait. A second confirmation is that we don't want to trade into a resistance unless we get confirmation to do so based on these patterns. A third confirmation is that we get an M formation. And the fourth confirmation is we get an alert box to go short because the mustard and the ketchup crossed over right there. So then we take a short. Look what happens. If we take a short here and we do a stop loss above the high, that's 12 pips. Hello, 12 pips. 12 pip stop loss for how much of a gain? Well, if you counted these levels properly, you could hold on to this position into the end of the week. Generally, you will see 3 pushes or 3 rises to the high, maybe even 4 or 5. It's like saying on the daily chart, if you see 4 or 5 candles in a row that are all of the same color, then normally the market will retrace a little bit afterwards, and then it will decide whether after that day that was the opposite of the previous 4 or 5 days, it will then decide from that point on forwards whether to keep on going the opposite way of those 4 candles or 5 candles that went up to, over 5 consecutive days. It will decide whether to keep on coming down or whether to go back up again. If it does decide to go back up again, you know you're on either 1 level or 2 level, and it will keep on going up. Alright, I could probably explain a little bit more over here on these ones, but let's try and finish our conversation here for the moment. So we get in here, and we could have taken it all the way down into the very next day for 115 pips on a 12 pip risk. That's 10 to 1. 10 to 1 win ratio. And if you've seen the size of the lots that guy trades, like 25, 50 lots, that's 50 grand right there. Alright, but I don't recommend in doing that, because that's made a lot of people go broke as well, because they get too much confidence in what they think they know what they're doing, and then find out that they've got into an M formation or W formation somewhere wrong. Alright, and they get all depressed because they've started spending their money before they even made it, and then they feel like they're back to square one again. I mean, I'm more than happy to show you how this strategy works to the full extent if you want, if you're having problems already trading it. So anyways, this, as I mentioned before, that this box here is when the dealing desk comes in, where the market makers come in and do an analysis and work out what to do. And when they get to here, this guy, who's ever on this desk, is talking to the guy on this desk. And he's saying, yeah, I've just trapped a whole bunch of positions. I've made them think that we're going to break the high of yesterday. I pushed them lower, trapped out a bunch of people that put their stops below the yesterday's low. And then I put them back the other way again to reinstill their confidence. Now it's up to you, buddy. Alright, thanks mate. No worries, boom, we'll take it down here. Okay, that's what they're like, kind of thing. That's how he phrases it. Alright. And yes, market makers do exist. I actually have a friend who's a market maker who's 21 years of age. He's actually worth $43 million, and he made that in like 2.5, 3 years or something as being a market maker. spending billions and billions, but it's pretty gross. But yeah, so um, yeah, and then basically what will happen is that you will see. Oops, I'm trying to get my pen out here. So as I say, once you've seen that M formation, you're more or less golden. You've got your stop loss up here. All right. Once this session starts, the New York session, the US session, when that starts, you're pretty much golden, because after now what's happened, we've got a 100 moving average here. If the market breaks below this line, they call this line the Mayo line. Okay. Generally, more times often than not, I mean, this isn't his idea of using the 100 moving average, or even using this one here. That's not his idea either. These are moving averages. These ones and these ones are ones that are used by professional traders on a day-to-day basis to work out whether the market is actually changing trend, or whether the bias is actually being pushed to the other side. Okay, when the market breaks, okay, and stays below that level and holds it, and then pushes away from it again, you know that that level is pretty safe. Alright, and then you can essentially take your stop loss, which is up here, and move it, halfway maybe. Don't take any lots off. Don't do that stupid mistake by going in at one lot and then taking off 0.5 lot. Don't bother doing that, because if you work out the math, you're leaving a lot of money left on the table. So don't do that. Alright, learn how to trade properly first, and then capitalize on it later. Alright, so once the US session starts, you can see that it held that level for a little while, and it stayed in the range of the lower part of the Asian session. Okay, and then it decided to move. It wasn't even a big range, it was only 30 pips, and then the market starts to pull back. Okay, I mean, there might have been people that would have gone long here, because it looks like a classical, bullish engulfing pattern. People might have wanted to take their longs up higher, but the market fell back a lot and they didn't want to close out. And then the market came back towards the end of the day, and it did not want these people to come back and take their positions off. They might have got in here and they left it lower. And then again, at the end of the day, what happens at the end of the day? Well, the new day starts. This is when the market makers are actually creating their spread. It's within the box range, which is 50 pips. It's within that range. These are the days that you really want to focus on. If they're like 60, 70, 80, you just don't even worry about that particular day or that particular pair. Move on to something different. Does that make sense? Alright, so we can reiterate again. Do not trade inside this box, which is pretty understandable. And notice I haven't even talked about the TDI yet. Alright, so don't worry about that right now. I'm just showing you how to trade it without the TDI. Alright. Okay, so what's happened is essentially, here is yesterday's previous high, and here's yesterday's previous low. It breaks the low. Alright, people might have put their stop losses, I don't know, maybe somewhere around here, after they've gone in on a break, thinking like doing a break here or something like that, on the yesterday's low. Again, it's a similar action here, taking a high, putting their stop losses below the range of yesterday, of the day prior. It's come back and tripped them out. So this could be the same thing that's happening again, is that we're still inside the box. The market's dropped, it's broken, triggered people's shorts, it's come down creating the low for the day. We don't even know if that is the low of the day at the moment, but at the moment we can see that this is the high of the day because it never got broken into the European session. And what do we see into the European session? Well, what did we see over here the day prior? We see the M, right? And we come in on the second leg. Okay, look what we've got here. An M formation again, right on the high of the day. These are key positions to get in on. And then we get in right here. And then the market drops in three pushes. Well, this is also being explained by those other guys. You know, there's one here, there's one here, and there's one here. And then the market comes down towards the end of the US session and it pulls back to hold people off. These two guys, the market makers, when they change desks, change hands, this guy is talking to this guy and says, look, I've already created a sentiment that we're going to go short, I've already trapped them back out, and now it's your job. Alright mate, well I'm not going to really do nothing really today, I'll probably wait until tomorrow. And we'll just let the market play out. Alright, so that's a 26-minute video there. So, you know, I'm not going to sort of do any more examples unless, you know, I get good feedback from you guys here, and maybe I can explain how to use the TDI, and also how to use these sort of moving averages in conjunction with this strategy, and sort of maybe explain the 1 hour and the 4 hour charts, and maybe how to find other starting points of the day, what anchors mean. Alright, so let me know what you thought of this video, and then I can probably continue with the next one. Alright, I'll see you in a bit. Have a great weekend guys. Bye.